Here's exactly how I would start day trading if I had to begin all over again. I wasted years learning the wrong things, jumping between indicators and strategies, so in this video I'll give you the simple, beginner-friendly roadmap I wish I had 10 years ago. Quick disclaimer, this isn't financial advice, I'm simply sharing what's worked for me over the years of refining, testing, and trading. So step 1 is building the simple foundation. Trading comes down to price moving because of buying and selling pressure. If you zoom out, you see slow long-term moves. Zoomed in, you see fast intraday moves and potentially more opportunities. As traders, it's our job not to predict the future, but it's our job to identify areas where price might move, define risk, and execute with consistency. Our job is to be profitable over a large sample size, understanding that we won't always be right, and even often as profitable traders, we might have a win rate less than 50%, meaning we want our winners to return more than a 1-to-1 risk to reward, ideally a 3-to-1 or 2-to-1, to bump up our numbers. Step 2 is the tools that you need. Now let's keep it tight and simple. You only need 3 things to get started. First of all is TradingView for charting. If you haven't seen it before, it's basically a tool where we can analyze and we can look at different charts. We can add in gold and other commodities, stocks, futures, forex, and even crypto, and we can flick through all the time frames, zoom out for a bigger picture over a period of months or years, or zoom right down to a lower time frame where we can see the small intraday moves. But essentially, TradingView is the tool that we use to draw our analysis based on historical market data, using our strategy to predict future market movements. The second thing we need is a broker account. So if you want to open a personal account using a company such as Fusion Markets, which are a regulated broker, are a no-brainer. This is who I use to trade my own personal capital. And there's also prop firms. The one that I'm using right now is Sure Leverage Funding. The reason being, they do 1-step and 2-step challenges, but they also do something incredible, which is instant funded accounts, which you can see this one is currently sat at $15,000 in profit. That's where you execute your trades and actually make money. When it comes to TradingView, you want to keep your chart as clean as possible on screen for analysis so that you don't overcomplicate your thought process. And we'll come to the technical analysis later on in the video. Step 3 is psychology, and this is where the beginner mindset shifts. So before learning a strategy, you should fix these 3 limiting beliefs that traders most often have. Number 1 is that losing doesn't mean failing. Losing is a regular part of trading, so try not to define yourself by the outcome of any singular trade. Number 2 is that being wrong doesn't mean your system is broken. You need to have a large enough sample size before making any changes to your plan. Zoom out and remember, one trading day is nothing in the grand scheme of things. But if you find your system could be improved by changing something over a large enough sample size backed by real data, then there's potentially room for opportunity there. And lastly, number 3 is that a profitable trade isn't automatically a good one. Something I say often to my students is the very best of trades can lose and the worst trades can win. So remember, we have an edge to follow, but ultimately there are no guarantees. Remember, trading is probability, not perfection. And before we cover some technicals on the chart, I want to go over some basic math. Now, it may seem complicated at first, but trust me, I'm not academic, and if I can make it work for me, you can make it work for you. Let's keep it short and focused. Here's a risk to reward tool that we have on TradingView, and it determines the risk versus the reward. You want to always make sure that what you're risking from a monetary point of view is always less than what your potential reward is, which is why I choose a 2-to-1 or 3-to-1 for the majority of my trades. So let's put some numbers behind it. From a monetary point of view, if you're risking $100 on a trade, which means that's the very most you can lose, you need to make sure that your upside potential is a minimum $200 or $300. Why? Because probabilities are at play. Sometimes your trade will get to around 1-to-1 and reverse take you out for a loss. Sometimes you'll get a 2-to-1 and then you'll often get 3-to-1s. This depends on how structured and disciplined you are at following your strategy. 2, how well are you able to manage your trade based on fundamentals, technicals, and emotional stability. And 3, overall probabilities in the market. Again, the very best setup can fail. So understanding that you're capping your risk at a monetary standpoint that you're comfortable losing is key. Risk management first, opportunity to make money second. If you're trading prop firms, then you will have underlying rules to use, such as daily drawdown limits and maximum drawdown thresholds. At least this point of view, your only capital at risk is the fee that you've purchased that challenge or that instant funded account with. Whereas when you're trading with personal funds, you're risking every dollar you put into that account. So have some basic math, understand that what you're risking needs to be something you are comfortable losing, and follow this risk management strategy to a T over a long period of time. Remember, if you're risking 1% and you're aiming for 2 or 3% gains, you don't need a high win rate to be consistent. Success comes from controlled losses and structured wins, and small wins compound over time. Now, step 5 is here. We're going to run over some simple technical analysis. I'm going to go over TradingView. We're going to run over a candlestick chart, and we're going to trade only using the essentials. These are the basics that you want to focus on. A higher time frame, such as the 4-hour, trending markets, such as highs and lows for liquidity, structure shifts where the trend is changing, and indicators such as trading sessions. You don't need 10 tools. You just need to understand where price wants to move from and to and why. So in TradingView, select a 4-hour time frame, and if you're seeing price creating higher highs and higher lows, this is a trend, and this is a bull trend. We have liquidity resting above every high and every low, and then when the trend changes, we'll see a market structure shift when price starts to create new lower lows and lower highs. We then do the same thing and identify where liquidity is resting, which gives us our optimal trade entry at areas of liquidity to then continue trading along with that trend, using timing in our favor. Especially when trading the US stock market, we want to be focusing on the New York trading session. So let's use bar replay and go over some live trading examples using this very simple and straightforward to follow strategy on the US 500. Now, what's the US 500? It's the SP 500. It's a collection of the top 500 American companies. It's basically the backbone of the US economy, and it's based on a US stock. So we're going to be trading this 99% of the time only during the New York session. And when it comes to strategy and building your first strategy, you need to choose a concept. You have trend, you have liquidity, breakouts, etc. You want to write a clear entry and exit rules, test it in TradingView, use bar replay, track your results, and then practice on a demo account over time. Your data will tell you then what works and what doesn't. Let's cover some examples now. So here on the SP 500, we can see that price was forming higher highs and higher lows. This is the 4-hour time frame, remember. So this is the first time frame we're wanting to focus on. Now, we clearly then have a bullish trend. Higher highs and higher lows. You can use any drawing tool just to identify that for yourself. What we want to understand is where the most recent range is. Now, if it's obvious for you on the chart, then draw it on using a Gann box or a rectangle tool. This is my Gann box setting, 0, 1. You can have a 0.5 for a midway point, but it's not that necessary. You want a high and a low, right? If price is quite messy, zoom in and go over to the line chart at the top of the screen, and it will show you where the highs and lows are. It will just remove the wicks. So even here, we can see a change of trend or a market structure shift earlier on, or you could use this one here as a more conservative change of trend. Now, what happens with price action once we get that change in trend? Well, price starts to print a series of lower lows and lower highs, meaning we now have a bearish trend. And if our job as traders is to identify a trend and trade along with it, then we know now at this point, we want to be only selling. So the next thing to do, now that we have trend and we have highs and lows, is to identify our trading range. So we use a Gann box again, and we go from the lowest point to the nearest high. Now, for an optimal trade entry, we want to be either in the premium of this bearish range, or ideally take liquidity resting above a 4-hour high. So let's play this forwards until price gets to a premium area. If it breaks a new low first, then we just move our range. Now we can see this 4-hour candlestick has not only pushed into premium, but at the same time, it's swept above this high. In order to get a liquidity sweep, we want to see a bearish candle close next, not a continuation to the upside. A continuation of a sequence of multiple bullish candles straight after this would signify a market structure shift or a change of trend bullish again. Now, if you zoom out, just remember that over time, the SP 500 is bullish. So these bearish trends, they are very short-lived on this current asset. But we follow using the 4-hour. I often refer to the 4-hour as my key driver because it's that reliable. It's a great time frame. It's not too slow. It's not too fast. It's the sweet spot in between. So let's play once more and we can see that the next 4-hour candle retraces straight away. So what it's done is it's collected liquidity resting above this previous high, which are traders that were short, it's their stop losses, and it's also institutes that were short prior to this but didn't have all of their sell limits executed. So price has come back to make price efficient, collect more orders before hopefully going and creating new lower lows. The second time frame to use, which is the one we're going to be executing trades on, is the 15-minute time frame. So if we move to the 15-minute time frame, we can see now the reaction at this level. Now, the only indicator I want you to use is my indicator. How to get hold of this, simply go to my Instagram, comment the word entry or DM me the word entry, and I'll send it straight to your emails for free. I'm not charging for this at all. It's completely free. If we look at the settings on this, what this does is a number of things. You can choose the Asia session, the London session, and the New York session. And we can also look at other things such as separating areas of liquidity using 6-hour segments. So when we put these onto the charts and we want to play forward, first of all, the Asia session in orange, we're not trading this. Now we can see these vertical lines are separating the crossover between the Asia session and the London session, which is this next gray session. We're not trading this because this is the US stock market. We're waiting for the US Open. And then the next crossover is between the London and the New York. Now, what do we look at here? We look at the same thing we did on the 4-hour, this move that went up into the 4-hour high. We use the most recent low and most recent high with our Ganbox tool or a rectangle. And we can see that price broke once and it broke a second time. So we've had a momentum shift or a change of trend on this same time frame. So we now are bearish on the 4-hour and we're bearish on the 15-minute in alignment with both time frames. This is often referred to as time frame alignment. Next, we're looking for liquidity. Same thing we did on the 4-hour. We have liquidity resting above these highs, which is the highest point of the crossover between Asia and London, and it's also session-based liquidity. Session-based liquidity is above and below sessions. As we can see, London swept Asia lows and reacted, and it's come straight into the opposing side session-based liquidity, resting above Asia highs. This is a key optimal area to look to collect more orders, often known as a liquidity sweep, and a great area to trade from. Now, we don't execute anything yet. We want a bearish candle inside the New York trading session at this area. So let's play this forward until we have that. New York session's not opened yet. One more candle. Here we go. So we've had a bearish candle that swept liquidity above all price of the trading day after a market structure shift, after a sweep of liquidity above a 4-hour high in a 4-hour bearish trend. Now this is an optimal entry. We place our sell stop below the candle. Around a 10-point stop is fine with this, giving enough breathing space for the trade to play out. And we're looking for a 3-to-1 risk to reward, which is pretty much in line with the lows of the trading day. Let's actually execute this trade as well. Sell here, stop loss here. So we're risking $500 and our gain should be around $1,500. Let's play this forwards. Once price moves to around 2-to-1, I'd move my stops to break even. In this case, this trade played out very quickly. There was not really much room other than that last 15-minute candle to move our stops to break even. It went on to hit our TP very fast. Now, this was an A+ setup that still could have lost, by the way, but it was an A+ setup. And if you watch this 2 or 3 times, what I've covered on the 4-hour and the 15-minute time frame, trend, highs and lows, market structure shifts, liquidity on both the 4-hour and the 15-minute time frame, you cannot go wrong, and it's going to make things so much easier for you. You will not believe it. So let's fast forward and show some ideas around buying as well. And I will watch to see this goes and takes the lows like so. And as soon as we see price print a low and start to move away from that low like so, that's when we can draw our new bearish range, the most final range like we did here, because we have a new lower low, a new lower high. We got a low here and a lower high here at the sweep. And let's remove all of this and understand what is important. Remove all these, keep your chart clean, remember. Now, Same thing. We are still bearish. We're still printing lower lows, lower highs. We are in the premium of this range. If price sweeps above this high, then we can look for sells. However, one thing to note is we've had this very quick retrace candle straight away. 2, that happened on a Friday, and we've now had a market opening gap. This area, this void, is where unfulfilled orders were placed on a Friday and were not filled by the brokerages or the exchanges over the weekend. Price is likely to come back and fill that at some point. But what we want to see on the 4-hour time frame is, remember, this bearish retrace candle, which we are absent. We don't have. What happens the next candle? Do we get one? No, it's bullish. The next one's bullish as well. The next one is also bullish. So we have a market structure shift. We now have a higher high, and we're expecting the 4-hour time frame to continue and then begin to print higher lows and higher highs, creating a new trend, which again, when we zoom out, is in alignment with the overall structure of the SP 500 that we're trading today. So now what we can do is we can drop down to the 15-minute time frame and have a look for opportunities. Okay, so we have our Asia session played out because we wanted to see commitment or a reversal on the 4-hour time frame. That did not happen. We saw continuation above London, which was another bullish 4-hour candle closure, a consolidation or sideways movement pre-New York, and then a continuation inside New York again. Now, what's absent here in the New York session? We don't have a sweep of liquidity. We have higher highs, higher lows on the 15-minute. We had a market structure shift or a change of trend on the 4-hour time frame by a break of a previous bearish high with commitment. We've had 4 4-hour candles close bullish beyond, so we're likely not to get a sweep and more downside play on the 4-hour. But we don't have a sweep of lows prior to any continuation during the New York session. We've simply seen higher highs and higher lows. Now, that's not normal for the stock market. What's normal is a run on liquidity and then a continuation. We've not had that yet. Now, that's why we can use these crosses again, the cross between the Asia-London session, then the 6-hour period between the London and the New York crossover, and then you can just mark the end of the trading day or call it a day whenever you finish trading. Now, mark out the highest point of London, that's been swept. Mark out the lowest point of London, that's still available, right? We also have the lowest point of the New York session, which is also available. So when London fails to sweep liquidity below Asia lows and continues during the New York session, something to write down, New York session is highly likely to come back on SP 500 or ES futures to come back and take liquidity before continuing the overall higher time frame trend. So we are looking for something like this. Now we can come and take the New York lows, or it can take the London lows. We don't know exactly. One tool that we can use is a fixed range volume profile, where we drag from the beginning of Asia to the highest point of the New York session only and only when we are expecting a pullback into a region to then continue a trend. So when we plot this, we can see we have 3 areas of high volume. We have the red line, which is the value area low, which is really low down, by the way. We have the black line, which is the point of control, which is in the center of the chart, and the origin of London. And this is the most powerful one. Then we have the value area high, which is what created the push during the New York session, which we know is very likely manipulation because this low did not sweep any liquidity. So now, if we want to be closer to the point of control, that means that the New York low is a low quality area of liquidity. We won't delete it, I'll keep it on there for now. But ideally, we want price to come down, sweep New York, at least mitigate the point of control, maybe even sweep London lows in the process because it's very close by, give a retrace candle, and then we enter targeting a 3-to-1, ideally around the highs of New York. Now let's see what happens when we press on. Price drives lower, it sweeps the low of both New York and London. It mitigates the point of control. We can draw this out as an area of high volume, and we wick and we close with a bullish candle. Now, if we want to get involved, we can get involved here. It's not too late in the day. We have about a 15-point stop on this one, And then if we want a 3-to-1, we can get a 2-to-1, pretty much a 2-to-1 almost to the highs of the day. But let's target a 3-to-1 on this because that's what we're looking for. And open up our trade panel. We go for a buy, same risk, stop loss at the low. This time we're risking about $750. So we want to target around 2,200, 2,300. And let's play this forward and see how this plays out. We get a slight retrace. Price then continues. We get a good push where that momentum is kicking in. And it goes and hits take profit. So that final tool was utilized when we have multiple levels of liquidity and we're unsure of where the best quality areas of liquidity are going to be below the New York lows or the London lows. We can see that the volume profile tool allowed us to get in at an optimal area. Now, of course, there's more to my strategy. It would be unfair to my students if I showed everything in one video, plus it'd be a very long video, but at least this will be able to help you as a beginner or intermediate trader to focus on what's the most powerful, fundamental part of my trading strategy that I use today after over 10 years in trading. Now, if you want more beginner-friendly breakdowns or technical analysis, liquidity, or strategy building, I have more videos linked below. And in this video in particular over here, where I deep dive into liquidity concepts, is going to help you to understand the movements of the markets furthermore. So check this video out next. And if this tutorial helped you out, make sure to like and share this video with a friend, subscribe to the channel, and start building your trading plan the right way.